Most people are intimidated by options because they think they're too complex. There are very complex strategies, but in this video, you'll learn the top 3 easiest option strategies that will provide significant returns with limited risk. I'm Mike Bellafiore, and we're a long-standing proprietary trading firm located in New York City since 2005, and now Miami as well, and proud to develop numerous consistently profitable traders. Watch, take notes, and learn from our prop firm so you can grow your trading account.
Hi, I'm Seth Freudberg, and I'm the head trader of SMB Capital's options trading desk here in Manhattan. And there's this misconception out there, I'm not sure where it came from, but there's this idea that option strategies are complicated and that you need some kind of a doctorate degree to trade options. And that couldn't be farther from the truth. And we're going to prove that to you in today's video, because almost anyone can get started trading options once they open up an approved account with an online broker. You just need to know how, so stick around if that sounds interesting to you. Before we get into the option strategy that we're going to be teaching you in today's video, if you're brand new to options trading and you don't know much about how options work, we've put together a video for you to understand options basics. And if you click the video appearing on your screen right now, it will lay out the groundwork for you to understand the strategy we'll be teaching you in today's video. Then when you're finished, you can come back and watch the rest of this video. One of the awesome things about options trading is that there's an option strategy for every kind of market environment: bullish, bearish, and even listless environments that aren't either bearish or bullish, where the market's just kind of channeling. And so, for example, let's say that you're a believer in the RSI indicator, and you don't have to be, by the way. You can use any indicator that you're comfortable with. But suppose that you like to use the RSI indicator, which can shed light on whether a stock or an index is overbought or oversold or somewhere in between. And so let's start with the simplest bullish option strategy that there is, which is known as a put credit spread. And let me show you an example of how this works. So let's head back to the end of the day on August 5th, 2024, when the SPX index, the S&P 500 index, in other words, had been selling off since mid-July. And that morning, it gapped down almost 200 points, which is massive. And so it's not that surprising that on that day, the RSI finally touched the bullish 30 level, having been descending to that point since mid-July. And so let's say that on that day, you became bullish on the market, and specifically the SPX index. Well, if you wanted to express this bullishness in a very safe way so that if you were wrong, you would still have an opportunity to win the trade, then you could have considered trading a bullish put credit spread that day. And so if you had pulled up an options chain expiring in about a month on September 6th, and you looked at the column called Delta, which will be displayed on any options trading broker's platform, and head down to the put side and find the nearest strike price to a 20 Delta put, which in this case is the 47.50 put, and we go ahead and sell one of those for that price of 69.65. Then we'll head down 50 points below that one to the 4700 put, and we'll buy that for 59.75 simultaneously. And when we do that, selling a put at 20 deltas, which is always going to be far below where the index is trading, and buying a put below that on the same options chain, when we do that, we are entering into what options traders refer to as a put credit spread, which is a very conservative but very high return bullish strategy, as you'll understand shortly. Now, before we go any further, because this is going to come up a few times in this video, I wanted to explain to you why we picked those 20 delta puts, because you may not have seen this concept before. The delta of an option is a mathematically arrived at prediction of how much an option's price is likely to move based upon how much the stock itself moves, or the index in this case, how much the index itself moves. And while it's a bit of a complicated topic, suffice it to say that an options delta has also been found to be highly correlated to the probability that an option will expire with value on the day that it does expire. And how does an index put option have value on the day it expires? And the answer is only when the index closes below that put option strike price. And so the delta is telling us that there's a 20% chance that the option will expire with value when it expires, meaning the index will close below its strike price of 47.50. which in turn means that there's an 80% chance that the put will expire with no value on that day. And obviously, there's an even greater chance that the option we bought below that will expire with no value. And so you may be wondering, why would we do something like this? And why is this a bullish trade? And you're going to find that out shortly, which you're going to find, I think, very interesting. But first, let's be clear on what has happened from a cash flow standpoint on this trade. So starting with the 47.50 puts we sold, we received the price of $66.65 for those. And remember, put options on indexes pay off $100 per point below the put strike price. And so we multiply that by 100, resulting in total positive cash from selling that put in the amount of $6,665. And then we turn around and pay out of that cash a cost of $59.75 for buying that put 50 points lower at $5,700 for protection, using the same kind of calculation. And so the net cash flow from selling that put credit spread is $690, for which your broker will require $43.10 in capital in your account, which represents your risk in the trade. We're sitting there with $690 in cash and awaiting the outcome of the trade. So let's move to the day that it expires, which is about a month later on September 6th. And as you can see, the RSI indicator was pretty much spot on in this case, and the index rallied over that next month, closing at 45.0842 on the day the trade expired, way above where it closed the day we first initiated the trade. And so now that the options have expired, we can assign a final value to the trade. And so starting with the $690 we received for selling the put credit spread originally, as you can see, the 47.50 put is located more than 650 points below the SPX closing price that day, and the 4700 put is even farther below the price. And so both options expire with zero value, resulting in a trade profit of the cash flow we received in the first place. That's $690 initial cash flow, which constitutes a 16% return in a little bit over a month, which is, of course, an outstanding return over such a short period of time. And so now you can see why we would have placed the short and long puts where we did, because both options expiring worthless is a good thing, actually a great thing, because if they do expire worthless, then we get to keep all of that cash flow. And what that means is that because we traded a 20 delta put credit spread, as long as the index didn't close below 47.50, which even originally was more than 400 points below the index's trading price at the start of the trade, then both options would expire worthless and your profit would have been $690. And so the cool thing about 20 delta put credit spreads is that since you are trading options that are located so far below the index price to start with, so low that there's only a 20% chance that they'll expire with any value, then there's an 80% chance they will expire worthless. So if you think about it, at any price above 47.50, you would have received the full $690 in cash flow, a 16% return with an 80% chance of winning, which in turn means that even if the RSI indicator was somewhat wrong, there's still a pretty good chance we would win the trade anyway, and that's pretty cool. Okay, so now let's move on to our second simple trade to understand, and that is the call credit spread. And just like the name implies, this trade is literally the opposite of the previous trade, when you've turned bearish on a stock or an index. So let's take a look at an example from the recent past. And so let's head back to December 2nd of last year, 2024. And as you can see, after that sell-off in August, the index was extremely bullish. And on December 2nd, the index hit yet another all-time high, closing at 60.8649 that day. And so just like we did before, pulling up an options chain that expires a month later on January 3rd, 2025, this time we head up to the call side of the options chain, looking for the closest to, again, a 20 delta call, which in this case is the 62.50 call with a delta of 18.9, which is more than 160 points above where the index is trading. And we go ahead and sell that one for $15.40 while we simultaneously scroll 50 points above that to the 6,300 call, and we go ahead and buy that one for $8.15. And so you can see that this is a parallel to what we did in that earlier bullish environment. This time we picked calls, which only have value when they expire if the index closes above their strike price, and we sold one of those and bought another one above that, yet both of them are located way above where the index is trading, and so the index is going to have to rally a lot more for either of those calls to have any value on expiration day. And so we call this a 20 delta call credit spread, and this is a bearish trade. And so just like in the case of the put credit spread, as you can see from the calculation, we again collect positive cash flow from executing this trade, gaining positive cash flow because the short call, being closer to the money, pulls in more cash than we're paying out for the long call. We're buying above it, which is farther from the money, farther from the market price. And that makes sense, right? An index option closer to the index price on the same options chain will always have a higher price than the one farther away because the one selling the call is taking more risk that he'll have a payout from his option than the seller of the option higher than that, because the market will have to move farther to make that higher call have any value at all. And in this case, we collect a net amount of $725. And this time, our broker will require a bit less capital because we collected a bit more premium. Okay, so now let's move to the day that this trade expires, which is a month later on January 3rd of 2025. And on that day, with the market selling off mildly right after our trade was initiated, you can see that the index closed at 59.4257, giving us the opportunity now to assign a final value to our trade. And as you can see in this case, the index closed well below both of the call options strike prices. So for the exact opposite reason, the fact that calls only have value if the index's closing price is above the call strike price, only in that case do they have value. But since the index's closing price is so far below the strike prices of both of these call options, the calls expire worthless, and that $725 in initial cash flow becomes our profit, which in this case constitutes a 16.9% return. And so I think you'd agree that both of those trades are pretty easy to understand and implement. And again, they have a very high probability of success because of our locating the short options at 20 deltas. So now we'll discuss our final simple option strategy, which I'm pretty sure is going to fascinate you. This strategy is actually a combination of the two strategies that we just taught you. And it's called an iron condor, which is actually a combination of a put credit spread below where the market's trading and a call credit spread above where the market is trading. And so we'll dive in and show you exactly how this works. And so a few days after that last bullish trade expired on January 6th, you'll notice something interesting, which is that the RSI is neither in an oversold level at 30 or an overbought condition at 70, but rather it's smack in the middle between the two at 51.07. And so the market appears to be neither oversold nor overbought. And so what some traders like to do in these circumstances is to put on a trade that is neither bullish nor bearish, but rather a trade that profits if the market is kind of neutral. And that's what an iron condor is all about. And so let's say that on that day, you again pulled up an options chain that expired a month later on February 5th and found on the call side the 20 delta call, which is the 6150 call, and sold that for 2155 while buying the 6200 call, again 50 points away for protection, paying 1190 for that call. Then simultaneously heading down to the 5775 put, the closest put to 20 deltas on the put side, and sold that for 30.40, and for protection bought the 57.25 put for 24.20. And so our cash flow in this case looks like this, with the cash received from selling the short call and the short put, and the cash paid for the long call and the long put. They net down to a net positive cash flow of $1,585, as you can see. And in this case, your broker will require less capital, specifically $3,415, because we collected so much more premium for one thing. And so with a 20 delta iron condor, you receive so much extra premium because you're getting a combination of the premium of both the call credit spread and the put credit spread. You're getting both. But on the other hand, you now have a lower probability of profit because there's a 20% chance that the calls will expire with value, and there's a 20% chance that the puts will expire with value. And therefore, there's a reduced 60% chance that the trade makes a profit by all of the options expiring with no value, which is still pretty good, but your chances of winning are now lower. Okay, so now let's move to the day that this iron condor trade expires. And as you can see, the index kind of consolidated since we put the trade on, closing at 60.6148, the day the trade expired. And so with that, let's examine the outcome of our trade, which is really interesting because as you can see, the 6150 and 6200 calls, both our call side options positions are located above the SPX price of 60.61. And because both of the puts are located below the SPX price by quite a bit, then all four options expire worthless, meaning that we get to keep all of that initial premium, which translates out to an impressive 46.4% return in just a month. And the return is so much higher in this case because, as we mentioned before, we collected so much more premium, receiving that combination of the call and put credit spread premiums. And at the same time, our broker required less capital than either of those two trades separately, which, of course, reduces the denominator and therefore increases the return. And so the potential for a winner is a bit lower, but the reward for a winner can be much larger, which is a reasonable trade-off. And so what I'd like you to take away from today's video is the fact that neither of these three strategies were particularly complicated if you spent the time to listen carefully to the points that we were making. And the more often you trade these strategies, honestly, they're going to seem like child's play as you gain experience. They simply are not at all difficult to execute or understand, and they can become a wonderful way for the beginning trader to commence his journey as an options trader without having to earn a doctorate degree in the process. Options trading really is easy once you understand the basic principles, and once you learn them, a whole world of high probability trading strategies can open up for you.
Now, if you'd like to learn 3 more option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, and the options income strategy that allows you to make consistent money whether the market goes up or down or sideways, and how to make money on a stock or index trade even if you're wrong on the direction, then click the link that's appearing right now at the top right-hand corner of your screen. That will open up the free workshop registration page in a new window. So don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com.